Receiving an inheritance can blow up your college plan. Today we're going to talk about how to protect your inheritance and reduce what you pay for college. The top three would be cashing out the retirement plan, in other words, just asking for a check. And of course that's simple and easy, but can create very big disasters, which we'll get into. You can disclaim your inheritance, and then it will roll to some other beneficiary. And then finally you can do a rollover to a beneficiary IRA or to a beneficiary Roth IRA. Now, there's some planning opportunities with both disclaiming and rolling over. So we're going to get into that a little bit more. But once you roll over, now you have an additional decision to make. If you roll it over to a beneficiary Roth or a beneficiary IRA, now you have to figure out how to take the money out. And there's essentially three options. You can withdraw the money over 10 years. You can cash it out, again, like we would at the beginning. Or you may qualify for a special rule if the beneficiary is a spouse of the original owner, or if the beneficiary is a minor child, or if the beneficiary is disabled, and a couple others. But for most families, it's going to be withdraw over 10 years or disclaim would be the two key areas. So I want to show you some examples of these various options and how they might work in the real world. So first we need to understand need-based aid. So need-based aid is based on the income and the assets of mom and dad and the student. And when we inherit money, now we're potentially inheriting assets that we may have to report, and or we're creating income that shows up on our taxes and therefore carries through to our financial aid forms and then ultimately impacts our aid, usually in the negative direction. So again, we want to try and minimize income and assets to the student and income and assets to the parent in order to preserve any aid that we might be able to receive. So let's take a quick look at how beneficiary IRAs are treated when it comes to financial aid. So the actual beneficiary IRA is not considered an asset for financial aid. Generally, retirement plans do not count, so when parents or students own IRAs or 401ks or all that type of thing, it's not reported as an asset. The same can be said for a beneficiary IRA. It is not reported as an asset. The challenge with a beneficiary IRA is you may have to take required minimum distributions. You may have to take money out. And when you take that money out, that will create a taxable event that will transfer to your taxes and again ultimately impact your financial aid. So as an example, if you had a $100,000 IRA and you took all $100,000 out and just cashed it out, that entire $100,000 would flow through to your taxes and it would have a dramatic impact on the amount of aid you're eligible for. So generally we don't want to do that. Now when it comes to the beneficiary Roth IRA, now the Roth is a little different in that it's still not an asset, just like all the other Roths, Roth 401k and Roths owned by parents or students do not count either. So again, all retirement plans are out. But when we take withdrawals from the Roth, they are not taxable. But it still might have an impact on your need-based aid because one of the processes of the tax return is it tracks untaxed income as well in some categories. And the Roth may show up there, and then that may ultimately transfer to financial aid and still have an impact on aid. So even though it's not a tax problem, it could still be a financial aid problem. So we still want to plan well and understand what we're doing with our Roth IRAs and what impact they may have. So let's take a look at taking withdrawals over 10 years. So the actual process would be you take the 401k or IRA or whatever it is that you're inheriting and you transfer it to a beneficiary IRA, which now is a new account with a new title on it, and it's important that you do this properly. But you'll create a beneficiary IRA. They're also called inherited IRA, or you will create a beneficiary Roth IRA, or an inherited Roth IRA would be the other name for that one. And then you need to take the money out over the next 10 years. So the year of the date of death is year 0. Year 1 starts the next year. And by the end of the 10th year, you need to have all the money taken out for the beneficiary. Now, if you're a spouse or a minor child, that would be the exception to the rule, and they would do things differently. But most of the time, what I see is a parent, grandparent, aunt, or uncle, or something like that, leaving money to a parent or a student where the only real option is the 10-year withdrawal. So one option, let's say you inherited $100,000, and one option is you could withdraw it level, and if we're earning around 5%, then we'd have to take out about $11,800 every year. And if we could start with the year at date of death, then we actually get 11 withdrawals. So we just take that out every year. That would then transfer to our taxes and have a relatively small impact compared to cashing it out. Now, sometimes as part of our planning, we might decide that we need to empty the IRA quickly and get it done. Now, this might be a case, let's say you have a freshman in high school or a kids in grade school, and you're saying, well, if I get the entire IRA empty before college starts, that may be to my advantage because then I'll be able to control my income better in the future. So in this example, we take out more over the next 4 or 5 years and get it out quickly. So $30,000 a year and then the remainder in the third year there. Conversely, we often see situations where the students are in school already. So they're already in late high school or already in college. And now the option is to delay your withdrawals. So we may have to take required minimum distributions while we're delaying. So in year 1 and year 2, we have minimum withdrawals, and that will have a minor impact. And then once college is over, then we can start taking it out more aggressively, say $20,000 a year over the next 6 years, and then the remainder in the 9th year. Sometimes it makes sense to coordinate our withdrawals with other income. So I've had business owners who have fluctuating income. So in the good years, they don't want to add more income to their already high income. So in those years, we could take minimum distribution. And then in the bad years, we take out a larger chunk in order to get the IRA completely withdrawn over the 10 years. But that can minimize the taxes because we're taking it out during lower tax brackets. And it can also have minimize and plan for need-based aid as well. So in this example, the good years, we're just taking required minimum distributions. And here in the bad years, we take out more. We take out the $20,000. Now you'll notice in the final year, we have to take out a larger chunk because we didn't get it all done. And we have to have it all out by the 10th year. And of course, once we transfer to a beneficiary IRA, we can still just take out the withdrawal. So in this example, let's say we inherited $100,000. We transferred it over to a beneficiary IRA, and then we decided the lump sum was the best option. We can still do that. So we take out, in this example, we have a little bit of growth, so we take out our $102,000 now because it earned a little bit while it was in the beneficiary IRA. And again, that's always an option. So when we're actually creating these beneficiary IRAs, we need to be careful and make sure it's titled properly. Now, a lot of investment companies and financial advisors understand this, but you want to make sure that you are working with someone that gives you good advice. Titling is key. Here's a couple examples of what it might look like. Grandpa Simpson IRA, and then his deceased date for the benefit of Homer Simpson beneficiary would be an example. And then there's another example as well, but we want to make sure we do that properly. And then the other important thing to realize is you can always change your withdrawals midstream. So you're not committing to a 10-year plan. You just need to take out at least an RMD every year, assuming RMDs are required. And then you can make decisions and change your mind for the future years if things change in your circumstances. Now, another key ingredient here is what's called the RMD rules, or required minimum distribution rules. They've not been finalized yet. These IRA rules are relatively new, and we're still waiting for clarification on how the RMDs will work under the 10-year rule. So some companies already require them. Other companies are thinking they're not required, and they're not requiring people to take them out. So again, we're waiting for final rules from the IRS, but in the meantime, we have a little bit of flexibility potentially. I don't know when the rules will be finalized. We've been waiting a year or two already. Hopefully soon we'll have better definition, but you certainly can move to a beneficiary IRA and then meet the rules as required when the new rules come out. So next I want to talk about disclaiming an account. So if you receive an IRA or Roth IRA or any other retirement plan as a beneficiary, you can disclaim your inheritance. In other words, you can say, well, yes, I'm supposed to get $100,000 of that 401k from grandma or great aunt or uncle or whatever it might be. But you can go back to the company and say, I disclaim my rights to that inheritance. And then that inheritance will roll to one of the other beneficiaries. And it could be other beneficiaries, it could be the contingent beneficiaries, or ultimately, if there aren't other beneficiaries, it might roll to the estate. Now, before you disclaim, of course, you want to know where it's going to go next and then decide if it makes sense to disclaim it from a larger standpoint. It doesn't make sense to disclaim $100,000 to protect $10,000 of aid. You'd be much better off to receive the $100,000 and use it to pay more for college than disclaiming it and having it go somewhere else. But here's a couple examples. So let's say grandma left two accounts to divide it equally by her two adult sons. The sons are in a slightly different place. John has his college all complete, so all he has is a bunch of college loans that the students and the parents have taken to pay for college. But again, college is over. Whereas his younger brother Paul actually has kids that are still in high school, and he's actually starting to plan for college. And he's trying to figure out whether or not he might qualify for need-based aid. So in this situation, we're supposed to take the IRA and divide it by 2, and they each get a piece. And we're going to take the stock portfolio and divide that by 2, and they each get a piece. Now, unfortunately, that doesn't work great for Paul and his college planning, because if he receives the stock portfolio, it's going to be considered an asset. And for John, he's going to receive the IRA, and then when he takes it out, he's going to have to pay taxes on it. So if the brothers can cooperate, they each can disclaim a portion of their inheritance, and then what they disclaim would end up going to the other brother. Now, once that's confirmed and they want to do that, well, then it kind of switches and it looks more like this, where each brother inherits $100,000 still, but now John receives the stock portfolio, which he can easily sell and pay off his loans. And Paul receives mostly the IRA, and that's more friendly for him when it comes to planning for need-based aid. So it's a win-win. It's just the brothers need to understand that they can disclaim and then actually do the disclaiming within 9 months of date of death. So you need to move relatively quickly. And there's a formal process where you have to fill out the proper forms. Typically, families are going to work with an attorney somehow in order to make sure that disclaiming process is done so that there's no adverse ramifications for taxes or other problems. So here's another example. Let's say grandma and grandpa have a large estate, 500,000, million, whatever it might be, and they've decided to take $100,000 off the top and set up a trust for Susie and another $100,000 to set up for a trust for Ben. Now, in this case, they put stipulations in the trust that says it must be used for college. Now, this can be a disaster when it comes to need-based aid because we're reporting assets that are in the student's name. They're highly assessed, and I've seen situations completely blow up when something like this happens. So once the kids disclaim the $100,000, it will flow instead to the everything else bucket that ultimately goes to mom or dad. Now, once dad has it, he can still use it to pay for college. It will just have a much lesser impact on need-based aid. I've seen situations where trusts, again, really blow things up when they're in the kid's name and cost literally tens or hundreds of thousands of dollars in financial aid because of them being structured wrong. All right, so this is all we have for you today. So remember that you have the 10-year rule and disclaiming as great tools to help plan with your IRAs and retirement plans. If you have more questions, feel free to reach out. That's all we have in this video. We'll see you next week.